Commodities have been full of surprises this year. Oil prices are down about 13% year to date. Yet, a quick look at the space overall, when you include commodities like gold, copper, natural gas, and others, you'll see the sector is up by roughly the same amount. My next guest says that's because there's a lot going on beneath the surface. Says we head into 2026. What does that mean for the outlook for prices and portfolio construction? Joining me now, Hussein Aladina, head of commodities at TD Asset Management. It is lovely to have you here.
Thanks for having me.
Let's start with the chart because that is going to illustrate, and that's the reason I talked about what I did when I started this conversation. Let's bring it up, and you tell me what we're looking at here.
Yeah, so this is a time series of the Bloomberg Commodity Index. That's the benchmark of the strategy that we manage, and it includes over 20 commodities. 1/3 of the basket is energy, so your crude, natural gas, gasoline, diesel, etc. 1/3 of the basket, roughly, is base and precious metals, and 1/3 is grain, softs, and livestock. So it's a diversified basket of commodity exposure. Generally, that's the benchmark that folks are looking at when they're thinking about portfolio construction and introducing commodities into their asset mix. When you read academic research, which is a ton of fun, 9 times out of 10,
yes, yeah.
9 times out of 10, they're referring to this benchmark when they're talking about why one should have a commodity allocation in a diversified, balanced portfolio.
Yeah, well, up and to the right is always a good thing, which it was.
Right? Well, look, I think this is interesting because when I speak with clients, they're like, well, oil's off 15% year to date,
yes.
Which is, to be clear, that's the spot price of oil,
right?
Which is very different than if you were long oil and rolling futures. That return this year is only down 6% because the curve is in backwardation. But the key here is that commodities are not homogeneous. They all have different supply-demand balances. What I think is homogeneous, though, for the commodity space is that capital has not been attracted into this space for the better part of 10 to 12 years. So we're starting to see the supply side across commodities tighten. There are exceptions. Today, oil, I think, is oversupplied. But generally speaking, we've starved the space of capital, and as a result, inventories are tightening because we continue to consume this stuff.
Can we show, I want to spend the first part talking about commodities within the portfolio. Second part, we'll talk about individual commodities. Tell me more about the starving of capital into the commodity space, and maybe how does that compare to previous periods and what you see?
Yeah, so commodities, so we have a ton of recency bias. Commodities, I guess pre-2020 spent 10 years in this, what I call exploitation phase. We were exploiting the investment that we made in the super cycle, which started in the early 2000s. The increase in price that we saw in the early 2000s brought about a tremendous amount of capital. We've joked about this before. It's not Amazon Prime. It takes time before that capital that you've put into the ground lends to an increase in oil production, copper production.
Long time.
5-10 years. So for the last 10-15 years, we've been exploiting it because we made all that investment, and capital has not gone into the commodity space, which is the right thing because prices were weak and balances were oversupplied. Today, if we look at where capital is going, it's going into Mag 7, AI, data centers, hyperscalers. Those functions are very, very commodity intensive. You need a lot of power to drive the language models. You need a lot of copper to move that power.
Yep.
And unlike prior cycles, we talked about the cycle which started in the 70s, capital prior to that was going into the Nifty 50, the Kodak Polaroid. In the cycle that started in the 2000s, the period before that saw capital go into the internet stocks, right? Pets.com, Mozilla, Netscape, etc. Those were not very commodity intensive places, right? Today, capital is going into a space that's very commodity intensive, right? And that space is taking capital away, if capital is fixed, away from commodities. Commodities have started to work, right? Commodity returns have averaged north of 10% annualized since 2020, but that's still not as meaningful as the returns folks are generating in the AI space.
Right.
And my concern is that where I'm spending money today is actually very, very commodity intensive, and I'm not spending sufficient capital to grow my commodity supply base.
Yeah, and I think that's the interesting, I guess, conundrum when you're saying, or not conundrum, opportunity from your perspective, is that we're saying that AI needs lots of commodities, yet the commodity space has been starved of capital because AI has been sucking up all the capital. And so it's like this almost this double reinforcing piece that you see where things could go.
Yeah, so I think commodity prices and commodity returns would would be positive and above average over the course of the next decade, irrespective of the AI, just because we've starved it of capital, and GDP continues to grow. So our consumption globally of commodities is growing. Now I have this additional fill-up where I'm actually creating a new source of demand, and it's meaningful, right? So I think the setup is actually quite interesting, and I don't think portfolios, Kim, are constructed to benefit from kind of this new reality.
And you were saying that just before we get to the individuals, but that's not just specific, I'll say, of gold, because we were talking about that, and also just general commodities. What do you see in portfolios versus what do you think should be true for portfolios?
Yeah, so if I look at the 20 years into COVID, I would argue that that period of depressed inflation, very low rates, was the anomaly. If I look at 100 years of data, that 20 years into COVID, or really the 15 years post the financial crisis and the QE and financial repression, led to very weak rates, very low inflation. And the optimal portfolio for that environment is a portfolio of fixed income and equities, right? You don't really need diversification because when inflation is low, fixed income and equities have a negative correlation, so you get your diversification there. You're not looking for inflation protection because there was no inflation. I don't think that we necessarily are in an environment where inflation is going to average the 5, 6, 7% that we saw after COVID, but I don't think it's a stretch to say that the 20 years into COVID was the anomaly, and it's likely that the volatility around both growth and inflation is going to be higher in the next 10 years. And that portfolio, if you're designing that portfolio, it includes infrastructure, it includes real estate, it includes commodities, because you have to hedge those other risks that we didn't really face in that sort of pre-COVID period.
Let's start with oil. I know we said it's down while the rest of the complex is up, but why is it down?
The balance is in surplus. We throughout the year were probably more less sort of bearish than consensus.
Right.
Last year got some weak data out of China, and the market rid off the idea of like demand growth. Demand is growing. The world is going to see probably 900 to 1 million barrels a day of demand growth this year. But you have non-OPEC production increasing on the heels of the high prices that we saw in 2011, 2012, and to a lesser extent, some of the price appreciation we saw in 2022. So longer lead time projects in Brazil, Guyana, and Canada are coming to fruition. But at the same time, we do have Permian production and shale production starting to flatten and decline. OPEC is adding barrels back to the market. On paper, we have a surplus of somewhere between 2 and 4 million barrels a day, which is big. We're going to see big inventory builds, and that should pressure prices over the course of the next 3 to 6 months. There's risk to this, Kim, of course, right? We have continuing geopolitics in the Middle East, continuing geopolitics in Russia, Ukraine, increased activity in the Caribbean. So there is risk, but on paper, your supply and demand looks bearish because of this increase in production. So we think that over the course of the near term there is downside. We think you could trade down into the low 50s, and ultimately that does discourage the producers from deploying capital, and we create an issue kind of down the road. But today's focus is very much on this oversupplied balance. Inventories are building on the water, so you've seen a tremendous increase of oil on the water. At some point that makes its way into sort of onshore inventories and challenges the price and the structure is our base case.
What about gold? And gold's had an incredible rally in the past little while, so how much longer?
Yeah, look, I think structurally the case for gold is very much this emerging market central bank buying that I'm probably putting you to death on. We've talked about it so many times. But emerging markets hold more aggregate reserves than developed markets. So I'm talking paper and gold in aggregate. But when I look at their asset allocation, they're sitting in a lot of paper. The weighted average gold holding for the developed market central bank is around 60% of assets. The number for the emerging market is 10%. And this is after they've bought over 1,000 tons a year for the last 3 years and after the price appreciation.
That's fascinating.
So I just will those emerging market central banks stop buying gold? They might pause when you see a big rally in price, but it's hard for me to believe that directionally the macro supports wanting to hold more dollars when you already have 90% of your reserves in dollars. So I think you'll continue to see that diversification. That'll continue to support gold. And I think you'll see retail institutional interest in gold that is a reflection of concerns around debasement or Fed independence or the performance of equities. It's remarkable, actually, that gold has done what it's done this year,
Absolutely.
notwithstanding the fact that equities have continued to perform.
Fascinating times. We've only got about 3 minutes. I'm trying to get this in, but critical minerals. Now I know some of these are rare earths, critical minerals. This is not something that you trade and hold and those types of things. But what's been interesting, as you mentioned, is what's now been declared a critical mineral.
Yeah. So the U.S. Last week or the week before came out with like an updated list on what's critical. Copper, nickel, alloy are there, and I think this really just underscores the importance of commodities in making the world work. The
National
U.S.
security.
Well,
yes.
and so the U.S. has recognized that like a lot of the things that we want to do requires these commodities. A lot of copper to build out the power generation, which has been underinvested in even before this sort of AI theme came to fruition. So I think this is an effort to underscore the importance of these commodities and to encourage domestic production.
Can I ask you about silver? I mean, it tends to track gold, but I know it has an industrial use as well, too.
Yeah, silver definitely has more of an industrial component than gold. We have invested throughout the year in silver from both the long and short side. We don't share the same sentiment to silver that we do to gold because we don't think that central banks are going to start buying silver. It's far more, it's larger to store. So it doesn't have that benefit, but it does trade and will continue to trade probably with gold, just a more volatile version.
And what about, I didn't know if we were in time, but we will. What about the grains and the soft commodities? What's your outlook for that?
Yeah, so the grains broadly, so grains and softs different. Grains have found quite a bit of price appreciation over the course of the last several weeks on anticipation of improved trade relations between China and the U.S. I think President Trump has probably tweeted specifically about soybeans more than a handful of times. When we look at the fundamental balances, China has been buying a lot of beans from Brazil, from Argentina over the course of the year. They may buy some more beans from the U.S., I think, to appease President Trump, but they're not taking 20 million tons, we don't think, this year. If we look at crush margins in China, if we look at the size of the hog herd in China, it's all contracting, and they're sitting on a pretty good quantity of beans. So we think that rally in grains is probably one to be sold. When we look at conditions in South America, Brazil, Argentina, estimates on their crops continue to get larger. I think there's been, again, a little bit of a relief rally on the heels of what might be more volume going from the U.S. to China, but the data doesn't support it.
I've only got literally 10 seconds.
Sure.
This is unfair, but weather. Weather is so much more volatile than it used to be. How does that play into how you see things?
It plays a meaningful role in natural gas in particular. So, we like today owning European gas because we think it's not pricing any weather risk. The start of the winter has been relatively mild, which is tempering things. We have a lot of winter ahead of us. Weather plays a role into our fundamental analysis. We assume normal weather. We will play on either side of that to see what happens, but ultimately, weather does play a role.